Hey, it's the Profit Answer Man, Rocky Lalvani. For those of you who are new to the show, check out my interview with Mike Michalowicz. It's episode 2. If you want to hear about each chapter in the Profit First book, go back and listen to episodes 3 through 13. Episode 1 is the why and how. 80% of business owners hate accounting. I don't blame them, but you need someone to help you make good financial decisions. Many bookkeepers and accountants are bad at this. Plus, they don't think like you do. You need someone on your team to help you make great financial decisions that ensure you have the time and freedom to do what you love. Remember, more revenue does not equal more profit. That's why we focus on the bottom line. Today, I have on my partner, Adam Lean, to talk about the 8 drivers that ensure great cash flow and profit in your business. These are the key performance indicators we all need to focus on as business owners. Let's meet our guest. Welcome to the Profit Answer Man, Adam Lean.
Hey, I'm excited to be here. Thanks for having me.
And I'm excited to have you here. Can you share with the audience a little bit about who you are and what you do?
Yeah, so I used to be an accountant. I graduated school with an accounting degree, and I thought, hey, I'll become an accountant with this fancy accounting degree. And I loved where I ended up working. I just hated the job of being an accountant. And I realized why, and that's because an accountant's job is to record what happened in the past. I mean, think about it. You take the financials and you record it properly so that the IRS is happy and everybody's happy. And that's it. You have not much influence over the business at all. And so I wanted to help the business. I wanted to improve the business, but really the job of the accountant is just to record what happened in the past and tidy up the books. And that was pretty much it. And so at nights and on the weekends, I started an e-commerce store. This is back in 2005. I started an e-commerce store that actually grew. And over the course of 4 years, I was able to leave my day job and focus on this business. And I enjoyed the building the business part, creating this business and building it. And that was exciting and fun. And then I started helping other friends that had businesses as well, and they were struggling. But the things they were struggling with, I wasn't really struggling with. And that pretty much all revolved around understanding their numbers. And it dawned on me that I had the benefit of understanding the numbers because I was an accountant. They didn't. And then I realized that most business owners, they're not numbers people, nor do they want to become numbers people. And so, but they still need help. They still need somebody to help them understand what's working and what's not and what to do about it in their business. Because as you can imagine, I mean, being a business owner can be lonely at times and exhausting and overwhelming, especially when you're not really sure why revenue is up or why revenue's down or why profit is up or why it's down or why there's no money in the bank. You really just don't know why. But imagine if you had somebody that could come in and just help speak in plain English and say, this is why, and this is what to do about it so that next month it looks better. And that's really what a CFO does, a chief financial officer. That's what they do on a larger scale for big businesses. That's why they employ them. I mean, Microsoft, one of the largest businesses in the world, has a CFO to help them make more money. And so every business needs somebody like that, but not every business can afford a $200,000 employee. And so I started what's called the CFO Project, where we give business owners the benefit of a CFO without the high price tag. And I started that several years ago, and that's what I do now.
It's funny. Even the accountants don't want to do accounting. Right?
Yes, I know.
And business owners don't want to do it. And again, same thing. We don't blame them. It's not the fun part of running the business. But at the end of the day, someone's got to do it. And then someone has to evaluate those numbers and do a phenomenal job of it. And that's why I'm glad that we were able to partner up and be able to help provide this service to customers.
Absolutely. I mean, and it's not the accountants. It's not their fault necessarily that they're not helping the business owner. That's just not what the accountant's getting paid to do. I mean, the accountant's job is to make sure that the books are accurate so that the IRS is happy. The taxes are filed and they're happy. But, most business owners turn to their accountant for precisely that help that the accountants can't provide. And a lot of the confusion comes in the form of the fact that the traditional accounting reports, like the profit and loss statement, also known as the income statement, and the balance sheet and those things, those reports are made for accountants. I mean, they were created for accountants. They are not created for business owners, and so that's what makes all of this so confusing. The accountant will give you your income statement and balance sheet at the end of the month and say, here you go. And then the accountant thinks they've done their job. But the business owner, unless you really understand how to read those reports and what to do about it, you're sort of just lost. You kind of put those reports to the side and you really don't want to admit that you don't really understand it, but it's also not your fault either. It's not the business owner's fault either, because you're not an accountant, nor do you want to be. And so there has to be some sort of help, some sort of guide that can help navigate the waters. And that's precisely what a CFO is supposed to do.
And that's very true. What I find is even when you understand the reports, they don't tie together very easily. Like there's this little things over on that report, which then you got to go over to this report. And then don't forget to look at that report. And then, hey,
right.
How come it says I'm profitable and there's no money in the bank? Well,
totally. I made $100,000 profit last year, but I have $3,000 in the bank.
Yeah.
What? That doesn't make sense. Where did it go?
So let's help them make sense. We're going to talk today about 8 drivers of profit and cash flow. What is the first driver?
Yeah. So real quick, just to explain what I mean about drivers of profit and cash flow. These are the things that influence profit and cash flow. When your accountant or bookkeeper says you made $10,000 in profit last month, they told you something that happened in the past. Based on that information, you don't know what to do to make $10,001 next month, or $12,000 or $20,000. You need to know what to do to influence profit and cash flow. And the other reason why those financial statements are confusing is that they tell you what happened in the past. So you get a report that shows your revenue was $50,000 and your profit was $10,000, for example. Well, that's good to know that what happened last month, but how do you know what needs to change to make those numbers better for next month? And so you need to know what numbers drive the profit and cash flow of the business. And so there's really 8 numbers that if you add all these up, all add up to profit and cash flow. And these are the 8 drivers, things that you can drive to influence and improve your revenue, profit, and cash flow. And I'll go through the 8 numbers, and then we can briefly talk through each one. But the first of the 8 numbers is leads. So how many leads from prospects that you've been able to generate through the use of your marketing efforts? You spend time and money and energy generating leads through your marketing efforts. So you need to start tracking how many leads you're getting.
And so, because you were in e-commerce, so for some people, a lead might be a website visit.
Absolutely. That's a very good point. Depending on your...
Yeah, it could. If you're a retail store, it's number of people walking in the door. If you're in kind of more of a direct sales type of thing, then it's more of a lead. It's somebody expressing interest.
That's exactly right. So if it's an e-commerce store, somebody landing on your website could be a visit, a visitor, or a session. Amazon calls it sessions. It really depends. If you have a brick and mortar retail store, a lead is somebody walking into the store. I mean, if you have a bike shop that sells high-end bicycles, a lead is somebody literally walking into the store. If it's a heating and air, for example, heating and air company, a lead could be somebody filling out a form on your website requesting a quote, or somebody calling. It's however you define a lead, but all of these are individual people that have somehow expressed some sort of interest in doing business, and they were made aware of you through in part of your marketing efforts. And leads are indicative of how well you're doing at marketing. So the second, go ahead.
Yep, that was my question. What's number 2?
The second driver is conversion rate. What percentage of those leads are you able to convert into a new client? So leads is number 1. The second driver is conversion rate, and this is a percentage. So if you got 100 leads this month, what percentage of those 100 leads can you convert into a client? This is indicative of this measures your sales ability. Leads measures your marketing ability. Conversion rate measures your sales ability. So if you get 100 leads, how well are you or your sales team or whatever, or if you have an e-commerce store, your online, your website, able to convert a lead into a client or a customer? So that's number 2. Then number 3 is your retention rate. So over the years, you've provided your products or services to a ton of customers. So as of December 31st of last year, if you total up all your customers that you've ever done business with, what percentage of those customers can you retain and get back to purchase this year?
And so this is an important one because some businesses don't have a retention rate. They need one because maybe it's a one-time sale type of a situation. But if you can take that customer from a one-time sale and create multiple sales, now your customer has tremendously higher value to you, and you have to do less work at number 1 and 2 because They're constantly buying from you.
Absolutely. And it's every business, I would guess 99% of the businesses needs to retain their customers. I mean, there's almost no instance where you would absolutely only service a customer once. For example, I had a client that owned a very large colonoscopy screening practice. Like, he had 15 doctors that worked for him, and they did colonoscopy screenings on people. Well, you get a colonoscopy every 5 years. You need, unless they, see something that needs immediate attention. If you're clean, they want you to come back in 5 years. So your retention rate should be every 5 years. That same customer should be retained. And that's a very easy way to retain customers. You need to reach out and get that same customer to come back. Why have that? If you did an okay job screening that patient 5 years ago, why would they go to your competitor? You needed to come back and see you. And there's so many ways, even at car dealerships, or you sell a car, to somebody last year. Who's to say that you can't upsell them into a different car or a maintenance package or get them to refer somebody in their network? I mean, there's just so many ways to retain a customer.
Very true. What's next?
All right. So that's number 3. Number 4 is purchase frequency. So whether you've gotten a new customer or a retained customer that have done business with you in the past, any customers that buy from you this year, whether they're new or retained, you need to get them to buy at a higher purchase frequency, at a higher rate this year. So, for example, if you have a grocery, think of a grocery store. If the average person, the average shopper shops every week, then that's a purchase frequency of 52. You got one customer to come back this year, and they're going to shop every week. That's a 52 on the purchase frequency. So how high can you get the same customer to come back this year and purchase from you? And then the 5th driver is your average purchase amount or value. So every time that customer, regardless if they're new or retained, every time they purchase from you this year, what's the value of that transaction, that purchase? Can you increase it? Now, let me pause right there. Those first five drivers, all are drivers of revenue. And that's another thing that makes the income statement so confusing is you get the income statement from your bookkeeper and you're looking at the number for revenue, which is the first line item, literally, on your income statement. If it's good, you're excited, but you don't really know how you increase revenue. If it's bad, if you had a bad revenue, if it dipped, you're depressed, but you really don't know how it dipped. You need to know the drivers that make up revenue. So did you have a marketing problem, or did you have a sales problem, or did you not have do you have a purchase frequency problem? I mean, those are five drivers that if you start tracking those, you can easily tell why your revenue's up and why your revenue is down. I mean, I have a client that is a prime example. When they came to me a couple of years ago, they thought that they had a marketing problem. They were spending so much money on getting leads. I mean, there was a lot of money on getting leads. They were increasing their Google Ads budget, their SEO on their website. They even hired a very expensive outsourced sales company or a marketing company to generate leads for them. That wasn't their problem. Once we started tracking these drivers, became apparent that they had a conversion problem. They were getting a ton of leads. They just weren't able to convert those leads that they were getting into actual clients. So we started working on their sales ability, their pitch, their proposals, the amount that they were quoting, the actual presentation of their products and services. Once those things, and once they started dialing in those things, their conversion rate went up, and they were able to increase profit because their revenue was increasing while they were spending less and less money on marketing, because they didn't need to spend as much marketing because their conversion rate went up. So these five drivers are just dials, if you will, that you could turn up or down, and they all add up to revenue.
And that they do.
Yeah, absolutely. And by the way, all these drivers, you can start tracking. Anybody can start tracking these on an Excel spreadsheet or on a whiteboard in your office. Just start tracking them and see every day or every week or month how well you're doing. And then number 6 is your gross profit. This is a percentage, also known as a gross profit margin. So if you take revenue, let's say you're a pizza restaurant, you have revenue you sell one pizza at $10, and you subtract out the direct cost, the cost that you only have to pay or incur because you sold that pizza. Let's say one large pizza, you have to buy the cheese for that one pizza, the dough, the box that it goes in. Let's say those costs add up to $4. That means you made $10 on the pizza, you spent $4. That means you made a $6 profit, gross profit. And if you convert that as a percentage of sales, that means you made a 60% gross profit margin. So that sixth driver is increasing the margin, that's 60%. So how can you get your gross profit margin to be 61% or 70%?
And, people think like, oh, I have a 50% gross profit margin, things are good. But in a lot of businesses, a 50% gross margin is very, very tight. Yeah. And so we really like to focus on doing our best to increase that gross margin as much as possible.
Absolutely. Yeah. And a lot of people ask, what's the best gross profit margin? And it really depends on the business itself. It depends on the industry you're in. And I've seen the same, or two different businesses in the same industry have wildly different gross profit margins. And there's both of them are right because it depended on the business and the environment and the local, the location of the business. There's so many factors involved. The best measurement to benchmark yourself is against yourself. If you had a 60% gross profit margin last year, see if you can get it higher this year and not worry about all the other people out there.
Very true. And on to number 7.
Number 7 is net profit. And this is a dollar amount. So once you've made a sale, your revenue, subtracted out your cost of sales, your direct cost of sales, that gives you your gross profit. To get to net profit, you have your expenses. So to have a higher net profit, you need to fine-tune your expenses, not necessarily reduce your expenses, but fine-tune your expenses to make sure that every expense has a positive return on investment. Here's what I mean by that. If you are spending $1,000 a month on marketing, you need to have a return on investment. You need to literally make $1,001 back in the form of profit in order for that to justify that marketing expense. If you're not doing that, there's no point in spending the money. You might as well keep it in the bank. And that's true for literally every single expense you have. So that's why it doesn't matter necessarily that you should, and this is a lot of accountants will say this, you should decrease your expenses to increase your profit. Although that's technically true, that may be horrible advice, because if you are really making a return on all your expenses, why would you decrease them?
Yeah, but most business owners spend too much. That is the reality of it. And they spend too much on things that don't make sense. And so one of the things I tell business owners, if you have, let's say, a 5% net profit margin, right? That means for every additional dollar you spend, you need $20 in revenue.
Mm-hmm.
So if you're thinking of this from a marketing standpoint, if you're going to spend $100 on marketing, it better be bringing you $2,000 in sales, because if it's not, you're actually losing. The marketing guy's getting rich, but you're getting poor.
Right.
Because
I
it's
agree.
costing you too much. So
that's right. Every expense has to be measured against this return.
Yes.
And in your example, it's the return on revenue.
Mm-hmm.
So it totally makes sense. But it has to, and you're right, most business owners are not spending wisely because they're not measuring the return on investment. And that's why I say you need to fine tune your expenses, not necessarily reduce them. In many cases, you probably will reduce them, but if you fine tune them. So going off my marketing example, if you spend $1,000 a month on marketing and it's producing a very nice return on investment, then you could theoretically increase that to $100,000 a month as long as it keeps the same return on investment. So you're improving your net profit by increasing expenses in this example.
Correct, but you better have the cash flow to handle that, all that new sales coming in, because that's going to be a problem. We talked about that last week where, someone won that big Costco order and went, oh my God, I can't afford this.
And that's actually our eighth driver is how much of that profit can the business keep? What percentage of that profit can the business keep in the form of cash? And you're absolutely right. If you don't have a lot of people can grow themselves out of a business. They grow too fast and they have no cash, and therefore they're out of business because they don't have cash. You can have a loss. You can have, instead of a profit, you can have a loss all day long, and still be okay as long as you have cash. So you can last, years without making a profit as long as you have cash, but you cannot last one day without cash. And that's why, like Uber, they've had losses for years. I don't think they've yet made a profit.
No.
But they have plenty of cash because these investors are pouring money into the business and they're able to survive.
But most of us don't have investors
Exactly.
that will pour money into our business that keeps losing money. Although some business owners try to do that themselves, and then they wonder why they're broke.
Right. You're exactly right.
We can't live like Uber.
You're exactly right. You took the words out of my mouth. That most businesses can't. I read a statistic, like 98.5% of all businesses in the country are small to medium-sized businesses who do not and cannot or shouldn't and should not probably in most cases take investor money or loads and loads of debt.
And that's very true. So we've got these 8 drivers, and I always tell business owners, you don't need to figure these drivers out. You just need to have somebody who can give you this information so that you can make wiser decisions, because you guys are smart. And I know that. It's just, getting the information presented to you in a way that you can take action on it.
Bingo. You're exactly right. And I know you do that really, really well for your clients. And business owners need, just like you said, they need help. And it's lonely and overwhelming being a business owner. And you can't turn to your employees for help because it's not prudent necessarily to talk about these types of issues. You can't turn to your spouse because they don't want to, they're not emotionally or mentally equipped to help you. In many cases, they don't want to know all the how the sausage is made, and you don't want to stress them out anymore. You need somebody that just gets it, that understands the business without your rose-colored glasses. Somebody on the outside that knows you enough, that you trust, that can be your confidant, but they can see the business for what it is and just sort of help you understand how the next steps that you need to take in order to grow your business or improve your business.
And so by knowing these 8 factors and knowing them over a period of time, it becomes very easy to look at the chart and say, okay, do we have enough people showing up into our store, website, or whatever? Number 2, those people who are showing up, are they buying, right? Then the next metric is, are they coming back? Mm-hmm. And then it's a matter of how often are they coming back and how much are they spending? So that drives that side of it. And then the second set is, what does that top dollar look like? And how much of that goes to product? And then the next one is how much are you actually keeping? And of course, we end with the fact that, do we have enough cash flowing to be able to sustain the business over time? And you can plan all of these things out forward and backwards. I know I was just sitting down with some of my clients. We're doing 13-week forward-looking cash flow. So they can look and see, hey, I have to spend X 3 weeks from now, 8 weeks from now. Can I afford to place this order? And will I have enough money to pay for it? And so these are all the types of things. It takes all the anxiety and stress away from it. Makes it easy.
Yep, absolutely. I love the 13-week cash flow because you're looking out essentially, weeks ahead. And if you do that all constantly, you always know if you're going to be in a cash crunch.
And then you can fix it, right? You can fix it now because you know there's a problem. Okay, what do we do today to start fixing that?
Yep.
Is there anything else we should chat about today?
I mean, I love talking about this stuff. So there, to sum it all up, you've got to focus on cash flow, but making sure that you increase your cash flow. To do that, you got to increase the profitability and health of your business. And to do that, you just need to start tracking those 8 drivers and find out which of those 8 are hurting your efforts or helping your efforts at increasing cash flow.
And that it is. Well, thank you so much for joining us today and helping us get a better idea of what drives our cash flow and puts money in our pocket at the end of the day.
Rocky, thank you so much for having me. It's been a pleasure.
As always, I enjoy hanging out and chatting with Adam. I've partnered with him and the CFO Project to help you implement the systems that we talked about today. We do all the work and walk you through the drivers and help you create actionable steps that you can assign out to your employees. If you want a done-for-you service, let's chat. The system works with Profit First, and Profit First helps to focus on 6, 7, and 8 in the key drivers. Most of our clients have between $500,000 and $5 million in revenue. At the end of the day, you can do this all yourself. Just set it up and start implementing and get to measuring what is important. If you'd like to chat with me, there's a scheduling link in the show notes, and we can get on a call to just see if we're a good fit for each other and we can support each other. If you want to learn about living the life of your dreams, check out my other podcast, Richer Soul, on whatever platform you're listening on. Let's close out by repeating the mantra. Revenue is vanity, profit is sanity, and cash is king. Let's thrive and grow. Have a profitable week.